Hello and welcome to this week's edition of Retire Well, the show designed to help you retire well in all areas of your life. I'm your host, Kristen Oakley, and I'm here with Kevin Bucher. He is the co-founder and a financial advisor at Citizen Advisory Group. And Kevin, I know we have another jam-packed show for all of you at home, and you want to get right to it, so let's do it.
Yeah, everybody wants to talk about investments all the time. They like to skip all the other areas of financial planning and get right into the investments. So that's what we're going to do today. We're going to talk about investments, in particular, the 60-40 portfolio. So it's long been held like the moderate investor's portfolio of choice. It was really rocked pretty hard in 2022, so we'll look at that, why that would have happened, and what's the outlook then for the traditional 60-40 portfolio.
I love it. Well, in order to set the context for today's discussion, we need to understand what it is we're talking about when we refer to this 60-40 portfolio. And so, Kevin, what is it that has long been the standard, if you will, for how folks should be allocated with their investments?
Yeah, so think of your pie chart. So if you think about your investment statements or how it's sometimes laid out, you got the pie chart that shows how much of your money you have invested in equities and how much money you have invested in fixed income. So equities, another word for that, are stocks, fixed income, bonds. So traditionally your 60-40 portfolio is 60% going into stocks, 40% going into fixed income, with the idea being that you're going to get your growth and appreciation from the stock side of things, but the fixed income piece is for risk mitigation and yield, and those two balancing together, hopefully providing stable, consistent returns without too much volatility in it.
So what's interesting is in 2022, a lot of people got a really rude wake-up call because stocks and bonds went down at the same time. So talk about that and how this whole concept of the 60-40 portfolio really got rocked that year.
Yeah, so it was an interesting year, to say the least, right? So we basically went from 20-year lows of interest rates to almost overnight, interest rates skyrocketed up. We saw 7 rate increases in 2022. They did kind of continue into 2023. But when interest rates are changing and when they're changing so rapidly, that does kind of play havoc on both stocks and bonds for different reasons. So when you look at the equity markets, the stocks, how does an interest rate change affect stocks? Well, when you're investing in stocks, you're investing in companies, and interest rate changes certainly affect companies because they're very sensitive to needing access to capital. The cheaper they can access capital, the better it is for their bottom line, right? So if they're going out to get loans to continue their operations, whether that's for payroll or expansion, the cost of those loans are now high, and that's going to affect the profitability of those companies and affect the market returns. So that's one area of how it affects equity. The other area would affect equities is there's competition in the marketplace for stocks.
Right. For
so long, we saw interest rates held so low, there was nowhere to go to try to make a return. But as interest rates jumped up and people could now make 4, 5, 5.5%, well, that puts a lot of competition on stocks. So people were starting to leave their equity investments and go into the more secured returns. And when those monies start to flow out of stocks, that pushes the values down.
Right.
So I don't know that people were too surprised, though, that they saw losses in that part of the portfolio because we expect to see volatility in the equity side.
Right.
But long term, that's where the better growth historically has been.
But what was interesting about that year, and I think where a lot of folks got rattled, was typically if stocks go down, then bonds go up. You kind of have this seesaw effect. But the fact that both went down at the same time meant that a lot of people lost a lot of money, but it wasn't necessary if things had been structured a different way. So I guess my question for you is the 60-40 portfolio really dead at this point? I mean, is that a thing of the past? What's your take on that kind of standard, if you will, for allocation?
Yeah, so when you look at what happened in 2022, and it's not like 2022 is the only year that bond markets were
It's just a very recent.
Yeah, and it was one of the worst bond market years that we've ever seen.
Right.
So when interest rates change like that, there is an inverse relationship between bond yields, the interest that they're paying, and the value of the bonds. And I don't know that that's that straightforward for people, but let me just give a quick example. That if I'm holding a bond Bonds generally pay interest. So when
Right.
you buy an interest, when you buy a bond, it's for a certain period of time and it pays interest to you while you're holding it. So if I'm holding, let's just say, for example, a 10-year bond that's paying me 2% interest, and interest rates are now jumping to 4.5%, 5%. Well, my bond that's only paying 2 isn't worth as much. I could certainly go to the marketplace and sell my bond because there's a marketplace for bonds, but people would only buy it at a deep discount because it's not worth as much. So that is what really pushed bond values down, in particular on the long-term bonds.
Right.
So where are we at now, though? We've already gone through the interest rate changes, and as we sit here today, the expectation in 2024 is that rates are going to stabilize, and then we're actually expecting rates to start to drop. So that inverse relationship between bond yields and your value is going to reverse course. So is the 60-40 portfolio dead? I would say it's not dead because we don't expect to continue to see the interest rate changes. But I also think this points out a fundamental difference in how people view their fixed income option or their options.
Yeah, so explain that.
When you look at your pie chart, for example, I think most consumers invest in the bonds piece for the safety and security that supposedly provides.
Right.
They're reducing their risk. They see it as a risk mitigation tool. But I think advisors and money managers in particular look at the bond sleeve or the fixed income sleeve a little different. They see it as a diversification tool. They're still willing to accept some of that interest rate sensitivity and price volatility because they don't view it as risk of loss aversion. So I think there's a big disconnect between how the industry is building the 60-40 portfolio and how consumers actually perceive the 60-40 portfolio.
That's a really good point. It's the perception of, am I going to be safe? And we know that no investment is void of any risk because even with quote unquote safe investments, you have inflationary risk, for example, interest rate risk, right? There's no place to hide. You can't avoid all risk, but what you can do is help mitigate it.
Yeah, and I think from our end of the spectrum and where we work, because we work with individuals, so we look at the bond sleeve based on how our clientele looks at it, and they're looking for safety and protection with what they're doing in the bonds. So when those bonds dropped, in some cases as much as 20%, in some cases the long-term bonds lost more than the equities in 2022.
Right.
So
and people are going, wait, I thought that was my safe place to put my money, right?
Yes.
Yeah.
So we do need to relook at the 60-40 portfolio, and we're going to do that in the next segment. But to your question, is the 60-40 portfolio dead? Well, if it is dead, it came back from death because 2023 was actually a pretty big bounce back year for the 60-40 portfolio. And it's because interest rates have stabilized. We saw strong returns in the equity markets.
Right.
And we've now seen higher yielding options on the fixed income sleeve because the interest rates being higher. So this isn't the first time we saw a lot of reports about, oh, is this dead or it's not dead? The reality is markets tend to move in cycles. There's going to be good periods and bad periods. But we just need to make sure that you have the right investment allocation for you and your individual situation. So if you're looking to have your investments looked at to make sure that you're not taking more risk, let our team of experts at Citizen Advisory Group help. We can provide a portfolio analysis, give you a deep dive into how much risk you're actually taking. And it's just part of our comprehensive financial checkpoint review.
Kevin, thank you. To our viewers at home, what Kevin is offering and the team of Citizen Advisory Group is that for no cost, no charge, no obligation, it's simply an invitation for you to come in, for them to be able to review your current financial situation and see how they can help and serve you. If you would like to take advantage of this complimentary retirement checkpoint review, it's really simple. All you need to do is call that number on the bottom of your screen, 866-630-1675. You're also welcome to take out your smartphone. And if you open up that camera app, you can point, click, and scan that QR code down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then you will be connected to the team to schedule your time to come in and receive your complimentary retirement checkpoint that way as well. When we come back, we're going to encourage to continue this conversation surrounding the 60-40 portfolio. How do you know if you're properly diversified, if you're properly allocated, and is it time for you to refinance your retirement? Stay with us to find out.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Kevin Bucher of Citizen Advisory Group. If you have amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. This is one of the greatest tax windows in history. Now is the time to take advantage of this tax discount while you can. We specialize in retirement planning, tax mitigation, legacy planning, and so much more. Plan your retirement right. Call now for your own complimentary portfolio review and written financial plan.
Welcome back. You're watching Retire Well. I'm your host, Kristen Oakley, here with Kevin Bucher, co-founder and financial advisor at Citizen Advisory Group. We are talking today about investment management, specifically the 60-40 portfolio, what it is it still working, what you need to know as we are in 2024 as it relates to your investments and investment strategy. And, you know, I think it's important to point out there's no one-size-fits-all strategy. I mean, we talk about this all the time. Everybody's financial situation is different, and what's right for you might not necessarily be what's right for the person sitting next to you. So I think one of the areas where the 60-40 concept has done a disservice is it's kind of led people to believe, oh, that's just what you need to do and set it, forget it, right? Let's talk about why it's so important to be properly diversified and expand on this concept of 60-40 and what it really means for folks in a practical sense.
Yeah, I think you really set the stage for that very well. So maybe you should just continue to go with it. No. So
it's a team effort,
yes.
co-collaborative,
So you
right?
set the stage for that really well because I can tell you what the 60-40 is not.
Mm-hmm.
The 60-40 portfolio is not the right solution for every single individual that's out there. Mm-hmm. The right investment allocation for you is very specific to you and your individual circumstances. So for too long, we've kind of settled for the default options that the marketplace presents to us.
True.
Because the big box brand name firms, the big national outlets, the names we all know,
right? Yep.
They are very accustomed to putting solutions out there to the masses.
It's more of that cookie cutter approach, right?
Correct, and I think that's where the 60-40 portfolio has gotten so much popularity because it's something that, okay, that makes sense and that's a solution we can go with, but it's not necessarily a solution that's been tailored to your individual circumstances. And that's what we do different at Citizen Advisory Group. We look at your individual situation. We're not trying to provide solutions to the masses of people there. We are looking to provide solutions for the individuals we sit across from every day and make an impact on their lives. Mm-hmm. So when it comes to the right investment allocation for you, there are certain things that we have to consider, and oftentimes it's not going to be a 60-40 split, right? Mm-hmm. So we have to look at things like, what are your goals and objectives? Mm-hmm. Obviously, everything has to start there.
Yep.
We're going to look at what is your capacity then to invest in the equity markets, because the equity markets are going to have more volatility to it. So based on what you need your investments to do and your capacity to take on risk, that has to be one of the considerations. Mm-hmm. That's the math and science behind, okay, what's the right allocation for you? But that's not the whole story, because we also then have to weigh in with what's your comfort level or tolerance to take risk.
Right.
That's where your lifestyle and how you feel about things come in to play. So I would call that the art side of financial planning. So we have to marry together the math and science with the real world applications. Yeah. And that often means that you're going to have a different allocation than just the cookie cutter 60-40 that's been put out there by the big brand firms.
Absolutely true. Let's drill down a little bit more specifically into true diversification as well, because I'm sure, I know I've seen it and I'm guessing you have as well. Do you find that when folks come in to meet with you for the first time that they're actually not as well diversified as they think they might be?
I would actually go a step further and say rarely is someone diversified like they think they are diversified?
So
right?
yeah, let's talk about that because there's different kinds of diversification and this is important as it relates to this conversation.
Yeah, I think everybody understands that you don't want to put all your eggs in one basket.
For sure.
Right? So if that basket goes bad, all your eggs are gone, right? So
Right.
you want to have different types of investments. But that doesn't necessarily mean that I just go buy 5 different funds because oftentimes when you peel back the cover of those 5 funds, what you find is those 5 funds are very similar. They have different names, but they're actually holding many of the same investments.
The same 60-40s a lot of times, right?
Yes.
The same stocks, the same bonds, yeah.
Yeah, so we really want to look at the exposure you have to different types of investment classes. So that is U.S. large cap stocks, that's U.S. small cap stocks. That's going to also include some international positions in the equity markets as well. It's going to do this. We're going to do the same thing in the bond markets. We're going to look at U.S. and international. We're going to look at short term, long term. We're going to look at U.S. treasuries. We're going to look at corporates. We're going to look at municipals. So when you're building out that portion of your portfolio, there's a lot of different options on how you build that. But then we also think it's important that we include in some alternative investments. That's where you're going to pick up some exposure to things like gold, silver, and real estate.
Right, natural resources, things
And
of that
maybe
nature.
even someday, maybe some exposure to cryptocurrencies, right? So we're not big advocates for putting a large chunk of money there, but we do
Right.
think it's appropriate to have a small allocation there, just like we do with gold and silver and real estate and some of the other asset categories as well.
You know, I always was taught when I first got into the industry that you want to be diversified and think of it as an elevator. Would you rather ride in an elevator with only 2 cables or would you rather be in an elevator that has 20, right? Because if one cable breaks, you want to know that you have 19 other cables holding you up. And that's how I always like to think of being truly diversified across asset classes.
And I think that leads right into the next thing we wanted to discuss today, which is maybe it's time to just rethink how you're doing the fixed income portion of your portfolio. So one of the positive or benefits of this rising interest rate environment we're in, we don't have to limit ourselves to looking at the traditional bond options or fixed income options because we can get a little more stability and security without having to sacrifice the return as much as we did when interest rates were essentially zero. So you mentioned this earlier, maybe it's time to refinance your retirement and take a look at maybe it's time to maybe exchange some of my fixed income for new fixed income and consider maybe I put in a CD. Maybe I put in a fixed rate annuity.
Right.
Maybe I put in a fixed indexed annuity and spending a little more time there. There's a lot of upside potential offered in fixed indexed annuities in the marketplace today that didn't exist in those products 2 years ago when interest rates were held so low.
Right. Yeah.
So we have the ability to participate in much higher earnings without taking the risk. And so I think that's a really attractive option for part of your fixed income allocation. So going back to that pie chart, it doesn't have to be just stock and bond. It can be stock and it can be bond, but maybe we include some CDs and fixed rate annuities in that equation. That's going to provide a little more stability to the bottom line.
Right. For sure.
Because they are not as sensitive to the interest rate changes as we saw in the bond markets of 2022.
They're not as correlated, one might say, right?
Which is the whole point of diversification.
Right.
Correlation
Yeah.
is the technical term for how we want to split our assets so that things aren't all moving in the same direction. And that's kind of the problem that we see with folks that aren't diversified as well as they think they are, is they're holding a couple different mutual funds, but when you put those mutual funds and chart them together, they're all moving in unison, doing the exact same thing at the same time.
Right.
And that's what we want to try to prevent in these down markets, is we want to have some portions of your portfolio that are actually moving in the opposite direction to smooth out that downside risk.
Well, when someone calls in today to receive their own complimentary retirement checkpoint review, when they come in, what are they going to be able to learn about how they're currently invested? What kind of reports are you going to be able to run for them that's actually going to show them how correlated they may or may not be?
Yeah, so we can do a portfolio analysis report that does exactly what you just described. It's going to do a full analysis. It's going to show where you're invested around the world. It's going to show how much exposure you have to the different types of investments. It's going to show where you maybe are overfunded or underfunded in certain categories. And maybe most importantly, it's going to show how much risk you're taking in the portfolio and how much you have to lose in the next market downturn. So if you're concerned about your investment allocation and where this economy and market could be heading, now is the time to take action. Let us perform that analysis report for you so you can see exactly how much risk you're taking and start to take the steps that you need to protect your dollars.
Kevin, thank you so much. To our viewers at home, if you're wondering if it's time for you to refinance your retirement and you're wondering, gosh, I don't even know how I'm currently invested, could I make some tweaks in my portfolio to serve me better? We encourage you, pick up the phone, call this number, 866-630-1675 to be able to set up a time and receive your complimentary retirement checkpoint review from Kevin and the team at Citizen Advisory Group. Or again, if you'd rather not call, you can simply scan that QR code and that will get you connected as well. Stay with us, more after this.
I think we recognize as a firm that thought of meeting with a financial advisor and discussing your personal finances causes some anxiety.
It can be kind of overwhelming or intimidating for some.
It's similar to the emotions I have about the dentist. I recognize that going to the dentist is really important. I want better dental health. I don't look forward to going to the dentist. But what I have found is it ends up not being as bad as what I thought. I think that relates really well to those emotions that people have about meeting with a financial advisor, that it might cause some anxiety, but it wasn't nearly as bad as you thought. And when it's all said and done, you feel so much more comfortable about the steps you took and the financial security that you're building for yourself.
We have a beautiful home office in Perrysburg that we built with intentionality. We want to try to take down those walls to make it home. When you come into our living room, the fireplace and couches, and when people come in, we want to have that comfort level of family and trust and open communication, just all the things that are important to be successful.
Welcome back. You're watching Retire Well with Kevin Bucher, co-founder, financial advisor with Citizen Advisory Group. I'm Kristen Oakley, your host. And Kevin, we've been having this very lively conversation. We've covered a lot on today's show, even though we started off by just focusing on the 60-40 portfolio. So to summarize, the 60-40 portfolio, is it still working or is it dead in your opinion?
Yeah, it's not dead. It actually has had a really good bounce back in 2023. I think the outlook moving forward for the 60-40 type portfolio is still favorable. But the 60-40 portfolio is not the only option out there, and your investment allocation should be very specific to what your goals and objectives are and what your tolerance for risk is. But with that said, there's more to your investment allocation than just your risk tolerance. There's more to it than just your risk capacity, because your investment allocation also needs to connect to your tax strategy.
Yes.
So I think the easiest way to look at that and explain that is we're talking about asset location. So where should you hold certain types of investments? Should you hold them in a taxable account? Should you hold them in the pre-tax account? So where should you hold some of your fixed income? Well, easiest maybe to just talk about a client example.
Yes.
Because taxes
I love your examples.
Well, so this is some clients we work with. Let's just call them the Smiths to keep their namesake, because there's a lot of Smiths out there, right? But this particular Smith is actually a retired CPA. He ran a big business. So taxes are something he's very familiar with, but he just doesn't really look at taxes through the same lens as a financial advisor who's looking long-term at the tax liability.
And really proactively planning ahead.
Yeah, so when we look at his investment allocation, he actually had somewhere between a 60-40 and a 70-30, and he was very astute when it came to his allocation and spent a lot of time just examining his allocation. And his fixed income allocation, because interest rates have jumped, he actually was doing some things on his own before he became a client that we were already doing with our clients. So he was repositioning some of his fixed income into more short-term interest-bearing things like U.S. Treasuries, short-term U.S. Treasuries, CDs. So he had built a little ladder for himself, similar strategy to what we were doing with our clients.
Right.
The flaw, though, and maybe flaw is too strong of a word, but the oversight was that he was holding those interest-bearing investments inside of his taxable account. So inside of the taxable account, all that interest earnings was showing up on his tax return. So not only was he paying tax on that interest earnings every year, it was also forcing more of his Social Security into being taxed.
Oh, wow. Yep.
So our suggestion to him was, well, let's not hold those interest-bearing investments inside the taxable account. Let's move that into your sheltered account and rebuy the equities that you're holding there in that taxable account, those equities that aren't paying the high dividends, that are more built for capital appreciation. So we were able to take off of his tax return a significant chunk of income, which decreased his taxes in that way, but it also decreased the taxes he was paying on his Social Security. It was the same investment portfolio.
Right.
It just wasn't set up to be as the most tax efficient.
Which we've talked on previous shows, it's important to not only be properly diversified across asset classes, but across having tax diversification as well. And that's a beautiful example. Again, we say this all the time, but to retire well, you have to understand how you make a decision in one area of your financial life can and will affect all of the others. And this is why you all are so passionate about helping folks engage in the comprehensive, holistic financial planning process.
Yes, holistic financial planning, and that was just one example of how these things are so connected together, and we can't look at these decisions in a vacuum. So we are offering a complimentary checkpoint review. That checkpoint is going to review the 5 financial planning areas for you. That starts with investment management, all the things we talked about today. What is your allocation? How much risk are you taking? How much do you stand to lose? Do you have the allocation that's right for you and your goals and objectives? That is just one of the 5 checkpoints. We're also going to take a look at your retirement income strategy. So if you're still working, that's the saving strategy. If you're getting into retirement, that's the withdrawal strategy from your investments. What is your income solution? That's the retirement section. We're also going to look at a full tax situation. Where are you at from a tax standpoint, and what can we do to assist you to reduce your long-term tax liability? Too often, taxes are looked at one time a year. Tax planning needs to happen all throughout the year to keep the tax man at bay. We're also going to look at your insurance package through the risk mitigation, and then finally the legacy and estate planning to make sure that you have your affairs in order to pass to your beneficiaries in the most efficient way possible.
This all fits together and it all works together, and it has to, right?
Well, there's a game to be played out there, and we just need to help you get in the game and play the game so that you can win.
Absolutely. Well, Kevin, it's always a joy to be with you. Thank you so much for being here. And to our viewers, thank you for joining us. If you would like to take advantage of this opportunity to receive your complimentary retirement checkpoint, the number to call is 866-630-1675. Be safe, be happy, be blessed. We look forward to being back with you next week.